If you want to become wealthy or financially free, the first thing you got to do is right now, you need to start investing a minimum of 15% of every dollar that you earn. If I told you that I am budgeting my money right now, that way I can live off of $7,000 a year, you're probably going to think that I'm never going to eat guacamole again, or I'm going to live in a box, or I'm gonna move to a third world country. But here's the thing, about 50 years ago, if you were living off of $7,000 a year, you'd be living pretty decent. I mean, $7,000 a year 50 years ago is like $50,000 a year today. This is where people think about building wealth and retirement and financial freedom all wrong, because people always talk about, okay, when I become financially free, my goal is to be able to live off of $50,000 a year. But your $50,000 a year that you're thinking of is today's money. $50,000 a year today is very different than $50,000 a year 50 years from now. Just like how $7,000 a year today is very different than what $7,000 a year was back 50 years ago. So when we're talking about building wealth and investing your money for retirement or this financial freedom or whatever you want to call it, you got to understand two things. One, you got to understand how your money works, that way you're using the money right way. And then second, you got to know how to invest this 15% and why you need to be investing this 15%. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. When the majority of people think of money, they relate it to stuff. How much stuff can my money buy me? If I make $1,000, what is this $1,000 worth? If you ask the majority of people, you relate $1,000 to how many nights can I go out, how many vacations can I go on, how many nice clothes can I buy, how many times can I buy extra guac. So the majority of people, when you think about money, is what stuff can I buy? The reason we call ourselves the minority mindset is because we think differently than the majority of people. When I want you to think about money, I want you to think about money in terms of how many assets can you buy. An asset is something that makes you money. And so now when you have $1,000 or $10,000 or $100,000, I want you to ask yourself, okay, now that I have this cash, how many assets, investments can I buy, which are things that are gonna make you more money? When I was younger and I made money, the question that I had was, how can I use this money to improve my car? I started by tinting my windows, and I got new rims, then I got subwoofers put in, then I got all this other stuff put in, and it was always this kind of like balance of, okay, I made $1,000, what can I do to my car? Ooh, I made $2,000, how can I upgrade my car? So anytime I made money before, it was, how can I spend this money in a way that's gonna better my car or whatever I have? This completely changed when I started investing in real estate, because after I bought my first real estate investment property, it was making me something like $250 a month in profit every single month. And once I got it up and running and going, it was $250 a month passively, which means I wasn't doing any work. Every month, $250 was being deposited into my account. Now, all of a sudden, the way I thought about money completely changed, because now I'm thinking in terms of houses and real estate instead of cars. Because now in my mind, I'm thinking, okay, if I can make $250 a month from one property, that means from two properties, I could make $500 a month. With 10 properties, I can make $2,500 a month. With 100 properties, I can make $25,000 a month every single month passively without me having to do any work. As you grow, you'll start to realize that there's easier ways to do this. Like, you might not have to buy 100 single family homes. Maybe you can buy an apartment complex, and some properties are gonna pay you more per unit than others. But in general, that mindset is true. Now I'm thinking about assets instead of liabilities. I'm thinking, okay, when I make money, what investments can I buy? What assets can I buy? How can I use my money to make myself wealthier? How can I use my money to build more assets? How can I use my money to create more value, instead of just using my money to spend on nice things? You want to have your nice things, I understand that. But when you make money, I want you to think about it in terms of assets instead of liabilities first. Once you start changing the way you look at money, it is going to be so much easier for you to start investing your money and put more money aside to investing, because before, putting this money aside was a chore, because now you are sacrificing a nicer car, you were sacrificing another vacation, you were sacrificing all these nice things. But now you're not making that sacrifice. Now you're working more towards your goals of buying more assets, because that's the way you're looking at money. Now you look at money as a tool to buy you more assets, which allow you to have nicer things. And now when you change the way you look at it, it's easier for you to make more of these sacrifices to buy more assets. That way you can have more freedom, have more wealth, and then ultimately have more of the nice things, the nicer cars, and nicer vacations. Now let's get into the numbers, because if you're subscribed to our channel, chances are you've heard me talk about our 75-15-10 plan, which says for every dollar that you earn, 15 cents cents is the minimum you should be investing, 10 cents is the minimum you should be saving, and 75 cents is the maximum you should be spending. Now, I'm gonna go over that 15% investing, why 15% and what the numbers actually look like when it comes to building your wealth. Here's the thing, investing is the real secret to building wealth for regular people. It is not building the next Amazon. It is not finding the next hot stock before it pops. It is not winning the lottery. It's not having a job that pays you $1 million a year. Yes, these things can help, but they are the exception to the rule. They're not the rule. So if you really want to build wealth, the secret is investing your money. And the issue here is so many people are not doing this, even though I think we should know this by now. It's hard because on one hand, we're never taught about money. Like, we don't go to school learning about how money works, how budgeting works, how investing works, how to build wealth. And on the second side, we just don't really have kind of a good financial culture when it comes to spending, because we live in this debt culture where it is completely normal to finance your wardrobe. And so this is kind of the culture that we live in. And the only kind of financial education that people get nowadays is you go to your job, and then your job gives you this packet which says, here's your 401k information. That's why right now, half of America is not investing any money. Not a single penny at all. And on top of that, the people that are investing, most of them are only investing their money in their 401k, even though your 401k was never intended to be your sole retirement or investment plan. So if we kind of diagram this out, if this pie represents America, that's a very lopsided pie. If this pie represents America, only half of these people, so these people are not investing any money. Only half of these people are investing any money at all. Now, out of these people that are investing any money, the majority of these people, so something like this, are investing their money only in their 401k. This is the only people that are investing their money in their 401k and out of their 401k. These are the only people that are creating their own wealth and retirement outside of what's kind of just given to you. Out of these people that are only investing their money in their 401k, which was never intended to be your sole retirement or wealth building or investment tool, out of these people, the average 401k contribution is just 7% of your income. So you have a huge chunk of Americans that are not investing any money. And then you have this big chunk of people that are investing their money, but they're only investing their money in their 401k, and the average contribution is just 7%, which means you have only a few percentage of Americans that are investing more than 7% of their income every single year towards their wealth, towards their retirement, towards their financial freedom. If you really want to become wealthy, you got to invest more than 7% of what you're making. Now, let me show you why investing a minimum of 15% of your income is so important. Let's assume that now when you're 21 years old, you go out and you get a job paying you just $30,000 a year. So you are making $30,000 a year, and let's assume that you're investing 15% of your income every single year before taxes. So that means you are investing right around $4,500. So I'm also going to assume that you're working a job where your salary is going to grow over time, and let's assume that your salary just grows by an average of 3% a year. Now, I know over time, hopefully, your salary will grow by more than this, but let's assume just 3% a year, because sometimes you're going to get a raise, sometimes you're going to go to a new job, maybe you'll get another bump there, maybe you get a promotion, but every single year you get a 3% annual bump, and as you continue to make more money, you continue to invest just 15% of your income. If you do that between the age of 21 and 65, you are going to save, so at 65, you continue to do this, you are going to put aside $400,000 over these 44 years. Now, if you just save this cash and you started living off of, let's say, $30,000 a year, then this $400,000 would last you about 13 years. After 13 years, this $400,000 would go away, but you also got to remember that this is $400,000 about 44 years from now. This $30,000 a year in 44 years is not going to have the same value as $30,000 today. I mean, by the time you're 65, if you continue to grow your income by 3% a year, you're going to be making more than $100,000 a year. So if you want to continue maintaining your lifestyle at 65, that means you got to pull out $100,000 a year here. So your money's only going to last you 4 years. By the time you're 70, you're going to be broke. So this saving model doesn't work, which is why I want you to invest this 15% a year. If you invested this 15% a year and this $400,000 went into your investments, and you got a below average return for the course of your life, and you only got a 4% annual return on your money, if you were able to get a 4% average return on your money over your lifetime, then this $400,000 will grow to right around $900,000. Quite a bit more, but you gotta remember, this is still quite a bit below average. If you got an average return of 7% a year, then this $400,000 you invested over your time would grow to $1.9 million on the side for you to now use however you want. And if you could grow your money by 10% a year, which is just a little bit above average, especially when you account for inflation, then your money would not grow to $1.9 million, it will grow to $4.8 million. But the only way this is going to happen is if you're investing 15% of your income every single year. Now look, this is where you got to really understand money, because so many people make this mistake that when they're planning for wealth or retirement or financial freedom, they're thinking in today's dollars. They're thinking, okay, I'm young today. I'm hoping that I can live off of $30,000 a year or $50,000 a year or $100,000 a year, because they're relating that to today's money. But $30,000 a year today is not going to be the same as $30,000 a year 45 years from now. That's why your income is hopefully going to be adjusted with inflation and go up by a couple percent or a few percent a year. If you are 21 today and you're making $30,000 a year, by the time you're 65, if your income grows by 3% a year, you're going to be making something like $106,000 a year by the time you're 65. So if we assume that $106,000 is what it takes for you to keep the same lifestyle at 65 as you do in 21, that means you got to be pulling out $100,000 a year when it comes time for you to retire in order to keep the same lifestyle that you have today. Now, depending on how much money you're making, that might seem like a whole lot of money or not enough money, but what you got to understand is that in 45 years, $100,000 a year is not going to be as much as $100,000 a year today. So you got to kind of plan for that with your money. And so if we're looking at this kind of income and you're thinking, all right, if I want to maintain my lifestyle, I got to be pulling out $100,000 a year. If you have $400,000 sitting there, that's not going to cut it. You're not going to have a very nice retirement or financial freedom, because after a few years, you're broke. Now here, if you get the 4% a year, now at least you have some more money. And what you got to also understand is, because this money is invested, you're hopefully going to continue growing it after you start pulling money out too, because you're not going to pull out all $900,000 at once, at least hopefully not. You're going to pull out $100,000, let the other money grow, pull out another $100,000, let the other money grow, and kind of go on like that. That way this can last you more than 9 years. And here, assuming you can just get an average return, now you really have money put aside for the rest of your life, because now you got money for at least the next 20 years. Because even if you're pulling out $100,000 at a time, that means you have your money growing for another 18 years after you pull this money out. So you pull out $100,000, your money continues to grow the next year, because you only pulled out $100,000, you still got $1.8 million in there. And the next year you pull out another $100,000, you have $1.7 million growing for you. So as long as you got money in the account, your money will continue to hopefully grow. I want you to be an aggressive investor. Actually, I need you to be an aggressive investor, because Social Security is becoming a thing of the past and pensions are becoming history. And so if you want to be able to take care of yourself and take care of your wealth and take care of your family and your finances, you got to be the one to put it in place, and you got to be the one to start taking action, because you cannot rely on the government to take care of you, because the government national debt is skyrocketing. They have their own problems. It is very hard and very painful to rely on somebody else, especially the government, to take care of you, which is why I want you to be an aggressive investor. That way you can take care of yourself and take care of your wealth. That way you can live your life the way you want, not worrying about what the government's going to give you. Now, there are different ways that you can invest your money. That way you don't have to actually sell your assets in order to have money in your hand. Like if you invest in rental properties, investment real estate, now you're creating passive income, cash flow. That way you can get cash in your hand every single month without you having to actually sell a property. And if you're investing in dividend paying stocks, now you're making money every quarter or every year from your stocks, and you don't have to actually sell your stocks to get paid. But I'll get to that in just a second. Now here's the thing, most people don't start investing their money as soon as they turn 21. What you need to understand is, the older you are, the more aggressively that you need to invest. Just because you're older and haven't started yet doesn't mean that you can't start. It just means you got to be a little bit more aggressive. There's in general two different ways that you can invest your money. You have one way of investing your money, which is through retirement accounts. This is through things like a 401k or an IRA. And then the second way that you can invest your money is through non-retirement accounts. This is through creating your own stock brokerage account and investing your money in stocks, or through investing your money in physical real estate, not through a retirement account. And so this is money you're not doing in a retirement account, versus retirement accounts, they can give you some tax benefits. benefits. The whole purpose of a retirement account is literally to help fund your retirement, because when you invest your money in these accounts, you can kind of get a tax deferral right now, and then your money can grow tax-free until it comes time for you to retire. Unless you use a Roth, then you're paying taxes today, and then you don't got to worry about taxes when it comes time for you to pull your money out. I'm not going to get into too many details on this, but the whole purpose of this is for you to invest your money. That way it can grow tax-free, but you cannot touch your money until it comes time for you to retire. If you want to learn more about that, I will link a video where I've already discussed this in the description below. The point that I'm trying to hammer home here is your retirement accounts are typically not enough, because your 401k and IRA has limits, and you got to make sure now that you're not investing your money based off of what the government limits you at. You got to be investing your money based off of the way you want to live your life in retirement. That's why I say a minimum of 15% of your money needs to go towards your investments. Some of that money can go towards your retirement accounts, but if that's not hitting the 15%, then you got to be investing your money on your own too. That means maybe you got to create your own stock brokerage account, or maybe you got to start investing in your own physical real estate. That way you can get passive income. But here, you got to know what your goal is first. If you want to see your money grow quickly and you don't mind taking on more risk, then you should consider investing your money in the stock market, especially in growth companies and these kind of more startup companies, where these companies are trying to grow as quick as possible, as fast as possible. There's more risk involved because startup companies can fail and they might not work out, but you have the opportunity to see your money grow a whole lot quicker, because these are companies that are working really hard to grow as big as possible and as fast as possible. If you just want to see slow and steady growth in your money, then you can look at investing your money in more blue chip companies. These blue chip companies are your bigger established companies that have already been there for a long time. They already have their systems, and you're just investing your money in this company. That way you can see your money grow slowly. The advantage with this is you have less risk, because these companies are already established. You already know how they're making money, and you can kind of reasonably predict how much money they're going to make and how fast they're going to grow, so you have less risk, and so you get lower potential returns. One thing that I do want to mention about investing your money in the stock market is that the stock picking game is not for most people, because picking stocks requires a lot of work, a lot of research, and a lot of upkeep. If you're not willing to do that, then instead of investing your money in individual companies, like trying to find the next Amazon or Google or Facebook, then what you can do is invest in something called a fund, like an index fund or an ETF, because these funds give you exposure to a whole bunch of different companies, and so you have less risk, you can put in less work, but now you're kind of growing with the stock market. I already made a video where I talked about that, so if you want to learn more about how to do that, I will link it for you in the description below. If you're looking for income, where now you can create cash flow or passive income coming into your account every month or every year, where now you can have money in your hands without selling your assets, then you want to be investing your money in things like dividend paying stocks, because dividend paying stocks typically pay you a check every 3 months. Or you can invest your money in real estate, because now if you own a house or you own an apartment complex, now every single month the people that are living in your real estate or using your real estate have to pay you rent every single month, because they're using your asset. So now when you own these assets, like a dividend paying stock or rental properties, now you're making money consistently without you having to physically sell your asset. Real estate is also a really good store for your money, because if you have a lot of cash and you want to put it somewhere safe, then real estate is a good place to do it, because now you own something physical and tangible that you can see, feel, and touch, and that's creating income. Now, I know real estate prices don't always go up. You could see a real estate crash, but in general, if you own a property in a good area, then you own something that people need, that something want, and that you can see, feel, and touch. The key for any of this to work though is you got to be consistent, and you got to keep investing your money, because investing is not a one-time thing. It's not like you can just take $10,000 and throw it in the market, or go out and buy one investment property and say, all right, I'm done investing now. It doesn't work like that. You gotta keep investing your money consistently if you wanna continue to build your wealth. Yes, if you see a market crash, then come and buy as much as you can then, because that gives you the opportunity to buy assets for pennies on the dollar. But in general, you gotta keep consistently investing if you wanna build this wealth, because you gotta keep putting more and more money towards your investments. Now, for a lot of people, they don't wanna be in the game of trying to find the best companies and do the research and find the best time to come in and buy, which is why I say do it every time you get paid. Just create a system. Anytime you get a paycheck, 15% of that should be automatically invested. That way it kind of happens without you having to think about it, and that way you don't accidentally spend this money. There are apps out there that can automate this whole process for you. That way anytime you get paid, a portion of your paycheck will automatically be invested into whatever funds or stocks that you want it to go to. That way your money is constantly just going out without you even seeing it, and that way you're not even tempted to touch your money. If you want to learn more about how to actually do that, our team wrote an amazing article on our website, theminoritymindset.com, and I'll link it for you in the description below. Building wealth is really a game where you got to juggle time and how much money you have to invest, because the more time that you have on your side, the more your wealth can compound and the bigger your wealth can grow. And the more money you have to invest, the faster that you can grow your wealth. But the tricky thing about this, if you look at it practically, is most of us make more money when we're 50 or 60 than we do when we're 21. And so you kind of get more of your money towards the end of your career, but you have more time in the early part of your career, which is why you got to balance it out. You got to start investing aggressively early. That way you can put more money and have the time on your side. That way you can kind of grow your money and have more money working for you. And as you start to make more money, you continue to keep investing 15% of your income month after month after month. That way you can continue to compound that wealth and continue to keep growing your money. Again, don't take what I'm saying as the ceiling. I want this to be the floor, because right now the average person is investing nothing or very little. I want you to kind of up the minimum and make it so you're investing a minimum of 15% of what you make. Once you get the hang of that, then up it up 20%, maybe 25%, depending on what you're making. The more you can invest, the faster you can build that wealth. And the faster you can build this wealth, the more assets and income that you'll have. That way you can live the life you want without worrying about the price, because you got your assets producing income, which can fund and buy you whatever it is you want. We're going to jump back into the show in just a minute, but before we do, here are a few words from our sponsor, M1. If you've been watching my videos, you've probably heard of me talk about passively investing your money in the stock market, where you have a CPA, a consistent, passive, and automatic system where money is automatically invested into the stock market for you. Well, a super easy to use platform that can help you passively invest your money into the stock market is M1. And as a little disclaimer, at the time of me recording this video, M1 is a tool that I use to passively invest my money into my portfolio of ETFs. The way it works is you get to create your pie or your portfolio of ETFs or stocks that you want to invest in, and then you can create a cadence of how often you want to invest into this portfolio of ETFs or stocks. For me, I invest every Wednesday. You can invest every 2 weeks, every month, but once you pick the cadence, you set it and forget it, and M1 is completely free for you to use. Now, of course, investing has risks. Are you guaranteed to make money when you invest? No, of course not. In fact, you will probably lose money at some point, which is why you want to always do your own due diligence and never blindly trust a random guy on YouTube. But you can mitigate some of your risk by investing your money into good assets for the long term, which is why I invest my money into my portfolio of ETFs, whether the market's up and down, because I'm investing for the long term. Now, of course, you want to do your own research, get a financial advisor if you need one, but M1 is a great tool that can allow you to passively invest your money yourself. Minority Mindset is a paid partner with M1, meaning if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more and create a free account with M1, I got the link to how you can do that down in the description below, or you can go to theminoritymindset.com/M1. That's theminoritymindset.com/the letter M and the number 1. And with that, let's go back to the show. Do you want to know how wealthy people organize their finances? Here's a hint. They don't just keep all their cash in one bank account. I'll show you. What wealthy people do is they have designated money for spending, they have designated money to be invested, and they have designated money to be saved for an emergency. They know what every dollar they earn is going to do. They build a system. I'm working to earn this amount of money, and then out of this amount of money, some of it is going to be spent, some of it is going to be invested, some of it is going to be saved. And the reason why is because they have built a financial plan. They've already built the financial models to know if I invest $1,000 a month or $500 a month or whatever the amount of money is, I'm going to be able to hit my financial goals. But in order to get there, you have to start by at least organizing your money. And the simplest thing you can do to do this is you got to just figure out where your money is going. And this one is a little bit difficult, but it is so necessary for every single person. You have to track your money. In business, we say if you cannot track it, you cannot optimize it. It's the exact same with your personal finances. So what I want you to do is take a piece of paper, take a Google sheet, I don't care, and you want to write down on the top how much money you're making. How much money did you make last month? I don't care if it's from your business, from your investments, your job. Write down where your money came from and write down how much money you made from your income, from your job, from your business, from your investments. Write that down at the top. Then below that, you want to write down your expenses. And you want to spend a little bit of time doing this. This is going to take time. Take out your credit card statements, take out your debit card statements, take out your bank account statements, and see where all of your money went and then categorize them by groceries, by your housing costs, by your vehicle costs. Categorize them and write down every single expense. You need to know where every penny went. And then below that, write the other places where your money went. Did you invest any money? If so, how much and where? Did you save any money? If so, how much and where? Did you give any money to charity? If so, how much and where? Now, when you do this, you're going to see a clear picture of how much money you're earning, how much money you're spending, how much money you're saving, how much money you're investing. Now, if you're not saving or investing any money, well, that's already a big red flag right there. And if your expenses are higher than your income, that's another huge red flag. And so now what you're going to see is, where is your money going? And immediately, I don't have to tell you what to do here. You're going to immediately be able to make adjustments in your finances because your money is going to be staring right back at you and saying, whoa, whoa, whoa. You're spending too much money at restaurants. You're spending too much money on airline tickets. You're spending too much money on travel. And if you're not tracking your money, you are never going to have a chance to become wealthy because you can't even see where your money is going. So that's the first step, is you got to track where your money is going. The second thing you want to do now is you have to open up at least 3 different bank accounts. And most banks are going to let you do this for free. If your bank is charging you, go out and find a new bank. You don't want to pay for your banking services. But you want to open 3 different bank accounts. And when you earn money, if you're getting paid a salary from your job or if your business is paying you a salary, this money needs to go into one checkings account. And then out of that checkings account, you want money to automatically be pulled out and put into your other 2 bank accounts. Because your bank account number 1 is your spending money. Bank account number 2 is going to be your investing money. And bank account number 3 needs to be your savings money. Now, the amount of money that you save is going to depend on where you are financially. I generally say somewhere between 3 to 12 months worth of expenses. You got to find the right number for you. I'm not a financial advisor. Everything that I say is for educational purposes only, so make sure you understand that. But generally, 3 to 12 months worth of expenses is going to be enough for people regardless of where you are in your life. So if you're 23 years old, you're just out of college, you don't got any financial liabilities, you don't got a lot of responsibilities, maybe you only need a few months worth of expenses saved up. If you're 45, you got kids, you got responsibilities, you got liabilities, maybe you need 6, 9, or 12 months worth of expenses depending on your risk tolerance. So you got to work to build up the savings depending on where you are financially. Your second bank account, which is your investing money, this is where your wealth is built. And the thing that you want to understand about this is there are ways for you to automatically actually invest your money. And then there are places where you just want to keep this cash waiting for a good investment opportunity. And this is going to depend on you because I personally like both. I have a system where money is automatically invested. Every Wednesday, I have cash that's leaving my checkings account that gets invested into the stock market. I'm investing into different asset classes like even physical gold every month. But let's talk about the stock market. Every Wednesday, cash is pulled out of my checkings account and is automatically invested into the stock market, whether the market's up or down, it does not matter. But I also am putting money into my investment account, my bank account, that's cash waiting to be invested, where I'm looking for a good investment opportunity. Now, this could be stocks, this could be real estate, this could be buying a business, this could be really anything. I'm just looking for a good investment opportunity because I am an investor. I like investing. This is something that I personally like doing. And I want to spend the time in that, and I also understand the risks. And so now you got to understand what type of investor are you. But the key is you have to separate the spending and the investing and the saving. And the reason why is because when you have all of your money in one bank account, it's very easy to just spend that money because most of us have this net zero mindset because we assume if I got $1,000 in my bank, I can spend $1,000. But to prevent that from happening is you want this money automatically put into your investing cash account and your savings account because now when you don't see that money in your spending account, you're not going to be able to spend it because there's no money there for you to spend. And this is going to make it a lot easier now for you to figure out what can you actually afford. Because when you are working to just spend money and then you invest whatever's left, you are never going to have a chance to become wealthy because you're prioritizing making everybody else rich. When you're working to spend money, when you're working to buy a nice car, when you're working to buy a big home, when you're working to buy the nice clothes, you're working to make everybody else rich. But when you're working to buy more investments, when you're working to buy more assets, now you are working to make yourself rich. But this requires you now to change the way that you organize your finances. And that's why at the very least, go out and create 3 different bank accounts. Now, a simple rule of thumb that you can follow is 75, 15, 10, which says for every dollar that you earn, 75 cents is the maximum that you can spend. 15 cents is the minimum that you're investing. 10 cents is the minimum that you're saving. And now many banks will allow you to build an automatic withdrawal and deposit into these bank accounts. So if you know that you're going to make $1,000 every 2 weeks, You can take $150 and put it into your investment account and put $100 into your savings account every 2 weeks. And you can automate this through your bank. That way now you don't accidentally spend your investment money on a brand new TV. That's the first thing. I'm going to jump back into the video in just 1 second, but before we do, if you are an investor and you're looking for an easy and free way to stay up to date on what's happening in the top financial news, from the economy to the housing market to the stock market to the crypto market to the global economy, then you have to check out Market Briefs. Market Briefs is my free financial newsletter that I created that will keep you up to date on what's happening in the financial news. You can read the newsletter in less than 5 minutes every morning. It's a fun and easy to read email, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. The next thing you want to do if you want to really organize your finances is you got to organize your investments. And that means now you got to figure out what is your investing strategy. Like what I was talking about just a couple minutes ago, when it comes to investing your money, you can be more of a passive investor, or you can be more of an active investor, or it could be a hybrid of both. I am a hybrid of both. I invest my money in 5 places. I invest my money into my own business, Briefs Media, along with other companies. I invest my money into physical real estate. I invest my money into the stock market. I invest my money into cryptocurrency. And I invest my money into physical gold. Now, I don't recommend what I do to anybody else, but this is my strategy. Some of these are passive. Some of these are active. Like my real estate investments are active. I have to go out and find rental properties. I have to go out and find good investment deals. And then I go out and I invest in it when I feel like it's a good price in a good area in a growing neighborhood. That's what I'm looking for. When it's the stock market, I have a passive strategy, but I also have an active strategy in the stock market as well. If I see a great investment opportunity in the stock market, maybe it's a great company that has just been hit hard by the economy or by something else going on in the market. Well, now I can go out and buy this company that I believe is a good investment and buy it. But beyond that, I have my passive strategy, which is every Wednesday, I have cash leaving my account and it's automatically being invested. And this is whether the market's up or whether the market's down. It does not matter. I'm always, no matter what, contributing to my investing. Now, the key here is you have to figure out what are you prioritizing. Are you going to prioritize your investing or are you going to prioritize your spending? Because most Americans, and I'm not saying this generally, I'm saying this statistically, most Americans prioritize their spending. Meaning, when something comes up in life, let's just say your friends want to go on a vacation, or somebody's having a baby, or somebody's having a wedding. What are you going to do? Are you going to prioritize paying for that gift or paying for that event? Or are you going to prioritize investing that money first? And if you really want to become wealthy, you have to prioritize building your wealth first. Which means sometimes you got to make some sacrifices. And you got to figure out which sacrifices you're willing to make. Maybe you got to downsize your car. Maybe you got to downsize your home. Maybe you got to downsize how many times you're going to eat out a week. Maybe you're going to downsize your clothes. You got to downsize something in order to make the ability to keep investing your money. And as you're doing that, the next thing you want to do is work to earn more money. Now, the reason why you want to work to earn more money isn't so you can drive a faster car. It's so you can own more assets, which will buy you that faster car. That is the key, because what wealthy people are doing is wealthy people are living off of their investments. They're not living off of the money they're working to earn. When you work hard to earn money and then you spend that hard-earned money, you are working hard to make everybody else rich. But when you work to earn money and then you take this hard-earned money and then you buy assets, you are working hard to make yourself rich. Now, these assets are going to be working to earn you more money, because if you own cash flow producing assets like dividend paying stocks or rental properties, now these assets are working hard to pay you. And if you can live off of this cash flow that your assets produce, now you are financially wealthy. Now the tough part is, this is hard. This is difficult. This is going to require you to make some sacrifices, because if you want to live off of your assets, it's going to take a lot of work. And this is why I call it a decade of sacrifice. It's going to take you a lot of time to see any real significant income from your cash flow producing assets. But if you keep putting money into these cash flow producing assets week after week, month after month, year after year, and you do this for a decade, after 10 years, I guarantee you're going to be able to have some significant income from your cash flow producing assets. But it's going to take you a decade. But if you can do that, now you have a whole new stream of income which can fund a big chunk of your lifestyle. But it requires you to start making that sacrifice today. Because what wealthy people are doing is, number one, they have organized their finances so every dollar that they earn has a job. Some of this money is going to be spent. Some of this money is going to be invested. Some of this money is going to be saved. The more money you put towards your investments, the wealthier you will become. Now, as you're investing your money, the second question is, how do you invest this money? Do you want to be more of an active investor or more of a passive investor? Then it's now, as you're investing your money, how can you use the income from your investments? Because true financial freedom comes from when your assets can pay for your lifestyle, but that's going to require you to put in that work now, to own the assets, to make the sacrifices, build the cash flow, and then start to live off the cash flow. And this is sacrifice after sacrifice, but if you can do this, now you're going to build that true financial wealth, that true financial freedom that most people only dream of. We're going to jump back into the show in just a minute, but first, here's an advertisement from our sponsor, me, with Briefs Media. If you're looking for an easy way to stay up to date on what's happening in the top finance and business news, we make it super easy for you to do that at Briefs Media because we created a free newsletter called Market Briefs. Market Briefs is a super simple and easy way for you to stay up to date on the top finance and business news. You can read Market Briefs in less than 5 minutes every morning. It's a fun and witty and easy to read newsletter, and I promise, if you join Market Briefs, you are going to love it. Now you might say, Jaspreet, how can you promise that I'm going to love Market Briefs? Well, if you don't love Market Briefs, you can unsubscribe at any time because it's completely free. So if you have not joined Market Briefs yet and you want to stay up to date on what's happening in the top finance and business news, I got the link to how you can join Market Briefs down in the description below, or you can go to briefs.co/market. That's briefs.co/market. And with that, let's go back to the show. Most people think that the way you build real wealth in the stock market is by finding the next Amazon stock before it pops off.
Amazing Amazon. The company becomes the second one ever to hit $1 trillion valuation.
This strategy works for some people, but not most people. Actually, when most people try to invest in stocks or pick stocks, they end up losing money, either because they overpay for the stock, or they don't know how to pick a good stock, or they sell their stock for a big loss because they get scared because something's happening in the economy, or they just sit on the sidelines and do nothing. However, everybody has the ability to be a millionaire stock market investor if you know how to do it the right way, and it's not by picking stocks, it's not by trading stocks, and it's not by starting off with millions of dollars. Let me show you. If you can invest $100 a month, and this is something that everybody should be able to do. If you cannot invest an additional $100 a month, then you need to go and watch some of my other videos about how you can live smaller or earn more money. That way you can put aside $100 a month. This is less than $4 a day. But if you invest $100 a month and you can get a 10% average return on your money, which historically has been the return of the stock market over the last century, and you do this for 46 years, you will retire with over $1 million in your investment account. If you put your money in the market and you can get the market return and you do this for long enough time, you will be a millionaire. The problem is most people don't do this. Most people don't get these returns. Most people lose money and then they hate the stock market and they think that investing is only for rich people. And in this video, I'm going to go over how you can actually become a millionaire in the stock market. And it's not by picking the best stocks. But if you really want to see that success in the stock market, you have to follow a system. And this is the 3-step system that I'm going to be talking about. Number 1 is research. Number 2 is fund. Number 3 is automate. Let's start by talking about number 1. How do you actually research the right way? Now, when I talk about doing research, I'm not talking about researching individual stocks. We're talking about researching investment vehicles. And the 3 that I'm going to be talking about are ETFs, mutual funds, and index funds. And all 3 of these work very similarly with some little differences between them. But in general, the way that these funds work is instead of you going out and investing in a company like Amazon, now what you're going to do is you're going to invest in a group of companies. If you invested in the Amazon company, you put all of your money into this Amazon stock and Amazon takes over the world, this would be great news for you as an investor because now your stock price would soar. But if Amazon does something bad and the CEO runs the company into the ground and then they declare bankruptcy, well, now your investment go down to zero. So when you invest your money into the individual company, you're taking on more risk. You can see more upside, but you can also see more downside. And this is where there's a lot of work required to find the right company, to research the right company, and then you have the psychology aspect to actually how do you invest in the company. When's a good time to buy? When's a good time to sell? And this is why the majority of people lose money in the market, because they don't have the time to do the research, they don't know how to do the research, and they don't have the psychology to invest their money in the stock market. That's why for the majority of people, it's a much better idea to invest in these types of funds, because now the way it works is instead of investing directly into the Amazon company, you're going to invest into this fund which owns the Amazon company. And in addition to Amazon, it might own some McDonald's, it might own some Coca-Cola, it might own some Nike, it might own some other stocks in here. And now you have this basket of maybe 100 stocks or 500 stocks or 1,000 stocks. So now, if Amazon takes over the world, well, you're going to see some benefit here in the fund, but it'll be balanced out by some of the losers. However, if Amazon went bankrupt, then the fund would kick Amazon out and put another company in. So now you're not going to be hurt as bad by the Amazon bankruptcy, because now they will replace it with another company and it'll be balanced out by some of the winners. So when you invest your money into these types of funds, you don't have to worry about doing the same type of research if you're trying to find the perfect company, because now this fund, whether it's an ETF, a mutual fund, or an index fund, is working to have the right group of companies there for you. That way now you're investing in a particular index, a particular basket of stocks, and I'll explain what that means in just a second, but you're picking this basket that you want to invest in, and then this basket will readjust based off of what companies should fit there. That way it's not a permanent group of companies. If Amazon goes bankrupt, it'll be kicked out, and maybe Chipotle will come in. So these types of funds lower your risk, meaning they lower your downside, but they also lower some of your upside. However, if you're just trying to meet the returns of the market, these funds can allow you to do that without all the time and without all the risk. Now, how do you find these types of funds? Well, this is where you can look at ETFs, mutual funds, and index funds, because they work similarly with a little bit of differences. So let me start by talking about mutual funds, because these are what are generally known as actively managed funds. That means that the person who's managing the fund is actually a person. They're typically a well-educated money manager who you're going to be paying a fee to manage. Now, the good side here is you have somebody there trying to find you the best stocks to keep in this fund. The downfall is it's going to cost you more money. The fees are going to be higher. Sometimes the fee will be worth it. Most of the time, it will be not. Now, mutual funds work similar to index funds in that they have some restrictions. If you want to invest your money into a mutual fund, most of the time, they're going to have limits to how much money you have to invest. There will typically be a minimum. It might be $100, it could be $5,000, it could be upwards of $5 million, just depending on what the fund is. But there will generally be some minimums in order to invest. Not all of them have minimums, but some of them do. And then many times, mutual funds will also have restrictions on how often you can buy and sell this fund. Unlike a stock, you can buy Amazon and sell it within the same minute. When you buy a mutual fund, you don't have the same ability. Many times, not all the time, but many times, you can only buy the mutual fund or sell it once in a day, and there's only one slot to do that. So you can buy it only once in a day, so you can't trade out of these funds. This is kind of similar to index funds, but the difference between index funds and mutual funds is that index funds are generally passively managed. And what that means is now instead of having a money manager manage it, you are going to have a computer managing the fund. What that means is now you can build an algorithm that I'm going to invest in an index of the biggest 500 companies in the stock market. This is what the S&P 500 is. So now when you enter this algorithm, the computer will automatically make adjustments when it needs to be done. If Amazon goes bankrupt, well, then the computer will kick Amazon out and they'll put in the next biggest company. Now, the advantage of this is your fees are significantly less. Now, sometimes this will be great, other times not, but overall, what we've seen throughout history is for the average person, the higher fees tend not to be worth it. This isn't the rule 100% of the time, but generally higher fees mean it's going to eat up more of your profits. Then index funds many times also do have the same minimums like mutual funds do. This can be as low as $100 up to millions of dollars depending on what the fund is. And then index funds many times also have the same restrictions where you can't trade in and out of an index fund the way you can a stock. ETFs work very similar to index funds, but they can be actively or passively managed. So these are active or passive, But the difference between now ETFs and mutual funds and index funds is they trade just like stocks. So you have no minimums generally unless there is a brokerage that you're working with that doesn't allow you to buy a fractional share. For example, if the share of an ETF is trading for $100 a share and you don't have $100, some brokerages will let you buy a fractional share for $20. So you're buying $20 of a $100 share. But besides the restrictions to buy a fractional share, there's generally no restrictions to buy an ETF. There's no minimums, and you don't have the restrictions because now you can trade in and out of an ETF whenever you want. This is where I want to remind you that if you want to succeed as this type of investor, this is called passive investing. If you want to succeed as a passive investor, the key is you have to be a long-term investor. And by long-term investor, I don't mean 6 months. I don't even mean 6 years. A passive investor is somebody who wants to invest in these passive investments for the next number of decades. When you have that type of long-term horizon, you can win as a passive investor, but you have to be in it for the long term. Personally, I'm a big fan of ETFs because of how easy they are to access, but for other people, that's exactly why they hate ETFs, because they don't want to have to sit there and monitor the stock brokerage accounts versus an index fund or a mutual fund. If you're buying it directly from the investment institution that's issuing it, well, now it's much simpler on your end because now you don't have to stress about what's happening in the stock market and staring at your stock brokerage portfolio each and every day. It kind of happens a little bit more discreetly because you're not seeing the day-to-day price moves the way you are with an ETF. This is where now when you're picking your investment vehicle, and I'm going to go over a bunch of different examples in just a second, you have to remember what your goal is as an investor because that's going to help guide your investment decisions. And your goal can generally be, I want growth with my money, meaning I want to see the value of an investment go up, or I want cash flow, or a hybrid of these two. Growth means I'm investing my money into something that has more risk, but it has the potential to grow a whole lot more quicker. Because now these are companies that are generally smaller, they're trying to grow quicker, they don't have a lot of profits because they're reinvesting all their money back into their company, versus cash flow is now, this is a company that has big profits. They're making a lot of money, they're already very large, and now with their profits, they can just pay it out to their investors, people like you and me, in the form of dividends. So now you're getting cash flow in your hand. It's a little bit less risky, but you're going to see a little bit less upside because now these companies aren't going to be growing as fast as maybe a growth company. So a little bit less risk, but you're getting more cash flow today versus I want more risk for the potential for higher potential growth. Now, once you know what your goal is, this can then dictate how you're going to be investing your money. For me, the bulk of my stock market portfolio, especially my passive portfolio, is for cash flow because for me, I like cash flow. Cash flow funds the guac flow because when I have this type of cash flow, well, now I have investments that are paying me every single quarter, and every 3 months I get more money deposited into my investment account. Now for me right now, this money that gets deposited is being reinvested, buying more cash flow producing assets. So every week I'm putting money into my accounts. That way it can buy me more cash flow. And then when my cash flow investments pay me with cash flow, I'm using this cash flow to buy even more cash flow. So it's like a machine that's constantly working to produce more cash flow for me. Let's go over some examples so you know exactly how this works and what it looks like. Now I gotta remind you that everything that I'm about to discuss are just examples. I'm not telling you what to invest in. You have to do your own research. Investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you need to always do your own due diligence and never blindly trust a random guy on YouTube. So let's go over some examples of how this works. Let's say you just want to put your money into the stock market. Well, there's an ETF for that. There's a total stock market ETF that gives you exposure to pretty much all the major stocks on the stock market. This is VTI. So if you invested in this VTI ETF, it is by an investment fund called Vanguard. You can look it up on Google. Go to Google and search VTI Vanguard and you will learn everything about this. And what you'll see is that this gives you exposure to the broad stock market. So when you invest in this, you're getting exposure to the stock market. If you want to invest in the S&P 500, which is a group of the 500 biggest companies on the stock market, well, there's an ETF for that. And I should also tell you that these ETFs with a star next to them are funds that I have my own money invested in, just as a disclaimer. But if you want to invest in the S&P 500, then you have a couple ways to do that. You have SPY and VOO. Both of these are two different ETFs that both give you exposure to the S&P 500. They're created by different investment institutions, but they invest in the same 500 companies generally. The difference is SPY and VOO will have a slight difference in asset allocation. That means that they value some companies more than others because both of these ETFs create funds of the 500 different companies and then they allocate their money accordingly based off of what they think is the best. Well, VOO and SPY have some slight differences. Like they value Tesla a little bit differently, they value Johnson & Johnson a little bit differently, but besides that, they work primarily the same way. Now, these are two ETFs. VFIAX is the index fund version to invest in the S&P 500. So now, if you put your money into this index fund, now you're investing into the S&P 500 through an index fund as opposed to an ETF. VOO and VFIAX work very similarly. This is an ETF, this is an index fund. They're both created by the same Vanguard. If you wanted to invest in the NASDAQ, which has a lot of exposure to tech companies, then you can look into the QQQ ETF. If you wanted to invest in the Dow Jones, you have DIA. If you wanted to invest in just value companies, well, Vanguard has an ETF for that. It's called VTV. If you wanted to invest in emerging markets, these are countries and companies overseas that don't rely on the dollar, that are working to grow. This is VWO. So it's a way to diversify your money outside of the United States. And if you want to invest your money into dividend-paying ETFs, this is an ETF that invests in high dividend-paying companies, then you can look at something like SCHD. This is a dividend ETF. Now, let me remind you that this is not a comprehensive list of ETFs. There are so many different ETFs out there. There are even more ETFs than just this for dividend or emerging stocks or everything else. There are so many ETFs out there, which is why this is just a place to start, and then you can start doing more research. But this is where now you can start asking, who is the company that's issuing the ETF? Because if it's a reputable company, well, then that gives you a little bit of assurance. Then you want to look at the number of assets under management, meaning how much money does this fund actually manage? This is very easily accessible information with a quick Google search. And then you want to research what are the actual assets in this fund. Like when we talked about VTI or VOO, you can see that these invest in a particular group of stocks, and each website will show you which companies are listed in this particular ETF. As an investor now, it's important for you not just to stay up to date on what's happening with your investments, but what's happening in the broader economy, because that can influence your investments. And an easy way for you to do that is to join something like Market Briefs. It's a free newsletter that I created to help people like you, to help investors stay up to date on what's happening in the financial markets. It's super easy to read. You can read it in less than 5 minutes every morning. And every day we're breaking down what's happening in things like the general economy, the stock market, the housing market, crypto, the global economy, into a fun, witty, and easy to read email. So if you haven't joined Market Briefs yet, it's completely free. And I'll put the link to how you can join for free down in the description below. The last bit that I want to talk about when it comes to the research aspect of knowing what you're investing in is looking at the expense ratio and the yield. The expense ratio is the fee that you're going to have to pay for investing your money into a fund. Whether it's an index fund or an ETF or a mutual fund, all of them are going to have a fee, and the fee is called the expense ratio. And this is very easy to find. You can go to Yahoo Finance to find this, Seeking Alpha. You can go to the actual investment institution that's issuing the fund. You just have to look at what the expense ratio is. And what you'll see is that this expense ratio is the fee that you're going to pay every single year for investing your money into this fund. When we talk about part number 2, I'll show you the real cost of this fee, which is why you want to have ideally a lower fee if possible. And then the second thing that you want to understand is the yield. This is the dividend. This is the cash flow that you get. Now, sometimes you're going to be investing in funds for the cash flow. Other funds, you might not be investing for the cash flow, but they might be paying cash flow as well. This yield is the cash flow that you will get. So if it says it's a 1% yield, that means if you invested $100 today, you will get $1 in cash flow just for owning the investment. And this is cash flow that you're getting, not for selling the stock, but just for owning the stock. This brings us to the second step of becoming a millionaire stock market investor, which is now how do you actually fund your investment the right way? Now, in the beginning of this video, I talked about how if you want to become a millionaire stock market investor, you could just invest $100 a month, get a 10% annual return for 46 years, which would reach a $1 million investment portfolio after 46 years. However, what I want you to understand now is that there's 3 aspects which will influence how wealthy you become in the stock market. And these 3 factors are how much money you invest. Here, we talked about $100 a month. Number 2 is the return that you get. Here we talked about the 10% annual return. And number 3 is how much time you invest your money for. Now, the only factor that we cannot change is time, because you cannot go back in time and start investing 10 years ago. So we're not going to talk about that, which is why the best time to start this is today, regardless of where you are in the economy, because, well, the more time, the better. Time in the market beats timing the market. This is what Warren Buffett always says. So now we have two factors that we can talk about. One is how much money you invest, and second is the return. When it comes to how much money you invest, this is going to depend on really your lifestyle. It's how much money do you make, and how much money do you spend, and how much margin is there that you can put towards your investments. If you're not happy with how much money you're making, then you can start by making more money. Does this mean getting a second job? Does this mean working harder at the job that you have now? Does this mean you're working for a promotion? Does this mean you're working for a raise or a bonus? Now you're working to earn more money with the purpose of investing more money, because the more you invest, the wealthier that you will become. If it's not from a job, can you create a side hustle? Can you start a business? Is there something else that you can do? Maybe you get a certificate, you look for a new career, you look for a new job, you do something that way you can earn more money, because now you're earning more money with the purpose of having more money to invest. Then on the flip side is also, can I spend less money? Are there places where you can cut back? Can you get rid of your car? Can you live a little bit smaller? Are there things that you don't need that you can sell, that you can get rid of? That way you have more cash now to invest. So you can earn more and you can spend less, which will create a bigger margin, meaning you have extra cash. But the question is, why are you having the extra cash now? Are you just going to keep this cash in the bank, or are you going to put this money to work? If you put this money to work, now you will have more money. So the key here now, if you want to see bigger success, well, you need more money to invest. The more money you invest, the wealthier you will become, period. And we just talked about how you can do that. You can earn more, you can spend less. I'm not going to go too deep into now how do you earn more, spend less in this video, but I have other videos on my channel where I discuss that. Now let's talk about the return, because this is what can now make or break your investments. And I want to start by talking about fees, because I kind of hinted at that when I was talking about the research, because fees can eat up your return. If we come back to this example here, where you turn your $100 a month investment to $1 million, but this time now you're putting your money into an investment that gives you a 1% fee. So you're getting the same return, but then you have a 1% fee. Well, this 1% fee isn't going to eat up 1% of your investment portfolio. It isn't even going to eat up 10% of your investment portfolio. It isn't even going to eat up 20% of your investment portfolio. If you have a 1% fee, you're not going to end up with $1 million. You're going to end up with right around $750,000, because a small little 1% fee isn't just a 1% fee you pay once. It's a 1% fee you pay on every dollar that you invest, which means you have less money invested. And then every dollar that your dollar grows to each and every year. So now you're compounding your money, but you're also compounding your fees over the entire course of your investment. Now again, this doesn't mean that these fees are never worth it. There are some places where these fees will be worth it, assuming that now you can justify the fee with higher returns. But you're going to need much higher returns to justify even just a 1% fee, because that 1% fee can really eat up the value of your investment portfolio over time. And if now you can't get a 10% return, but you get a 7% annual return, well, now the years are a little bit different. If you're still investing the $100 a month, now it's going to take you 60 years to hit the $1 million. If you're investing the $300 a month, now it's going to take you 44 years to hit that $1 million mark. And if you can invest $1,000 a month, now it'll take you 28 years to hit that $1 million mark. Again, it's very accessible. The more money you invest, the more wealth you will achieve. But this is where understanding that these types of returns are achievable, and you can get better returns the more research you do. But this is where you got to pay attention to the fee and what you're investing in. But you have to be willing to do the research. You have to be willing to fund it. And then you got to do number 3, which is automate it. The way you can actually succeed as this type of passive investor is you want this to be as passive and automatic as possible, meaning every week or every 2 weeks or every month, you pick your own interval, but every so often, money is automatically going to be invested, and this does not change. It doesn't matter if the market's up or down. You do this for a number of years, if not decades. That way you can actually build wealth, because you need the time, but you have to have it be passive, and that means you want it to be automatic because you don't want it to rely on you. Now, there's a lot of brokerages out there that will automate this process for you. Personally, I use something called M1 Finance. I have been sponsored by M1 Finance in the past. They are an affiliate for Minority Mindset, meaning if you use any of my affiliate links for them, we will get compensated, but I want you to do your own due diligence because it's just what I like. I want you to find the best app for you. Now, if you want to learn more about M1 Finance, I have my affiliate link down in the description, but the reason why I like M1 Finance for this type of passive investing It's because all they do is passive investing. They do it without fees. And on top of that, it's super simple to use. So for me, the way that I do it, and again, create your own strategy. For me, this is just how I do it. For me, every Wednesday, I have cash that leaves my checking account and is automatically invested into my portfolio of ETFs. The reason why I do Wednesday is not any sort of secret sauce or anything. I used to do Monday or Friday, but the problem was that was when the federal holidays would fall. And so there was a number of weeks where I just wouldn't get any money invested because there would be a federal holiday. So I decided to put it in the middle of the week. That way the federal holidays don't really affect my investing schedule because I want to keep investing as often as possible. For me, I like it every week just because it's more often. So I get a better dollar cost average because of that, but you can pick your own strategy for you. So for me, I have it set up so every Wednesday cash leaves my checking account and it is automatically invested into my portfolio ETFs. I don't have to check it. I don't have to touch it. I don't have to do anything. It is on autopilot. So now it happens and I don't have to worry about it. For me, it's completely automatic, it's completely passive, and it's a tool that is working to now build me wealth on the side in addition to everything else that I'm doing. I have my active investment portfolio as well, where now I have my stocks in a different brokerage, where now I'm looking for companies to invest in. I'm looking for individual companies that I believe are good valued for me to invest in, but that is my active investments. It's more risky, more time intensive. My passive investments in the stock market are on autopilot, and now when I get my cash flow from my passive investments, it's automatically invested. So it's working to buy me more cash flow. So every week I'm putting more money into it. Some of these investments are paying me with cash flow. When I get this cash flow, it's buying me even more cash flow investments. So it's like a machine working to buy me assets, and these assets are buying me more assets themselves. The key here for you is you don't want to turn this off because people get scared. Oh, the market's going down, so I should sell out of this. Or I should change my strategy because of what's happening outside. Once you pick the ETFs that you want, you're done on your end. Now you set it up and forget it. You don't have to touch it because now the ETF should be working to pick the investments, to pick the assets, and you just have to keep funding it. The only time you would change it is if something's wrong with the investment institution that your ETF is with, or if something is wrong with the ETFs that you invested in. If you feel like you shouldn't have invested in those ETFs and you want to change it because of that, that would be the reasons why you change it. You shouldn't be changing or selling out of your ETFs just because we're going through an economic slowdown. Economic slowdowns, recessions, and market crashes happen. They have happened pretty much every decade now. So you should expect them to continue to happen, and those are just opportunities if you change anything to buy more, and that's it. You shouldn't be changing a strategy besides that. So if you want to be a millionaire stock market investor, you don't have to go out and try to find the next Amazon stock. Instead, you can find the right funds to invest in. These are ETFs, mutual funds, or index funds. And of course, when you're doing this, you want to make sure you research the funds, see what they're investing in, and make sure that aligns with their investment goals and your time horizon. Now, you find the right funds that you want to invest in. The next thing you want to do is set up a system where you're funding these ETFs, and you want to also pay attention to the fees, pay attention to the yield, pay attention to the numbers, make sure that it aligns with your goals. Then you have to automate the system. The way that you win and actually become a millionaire stock market investor is by investing for the long term. You set up an automatic system that was completely passive, and it keeps happening no matter what, and you don't change your strategy just based off of what's happening in the economy. If you keep blindly following the system like the majority of people are doing, you're going to end up like the majority of people. And you don't want to do that. So what I want to do today is go over the 5 biggest ways that the system is keeping so many people poor right now, that we can stop doing these things and stop living like the majority of people. So let's start with number 1. First, there's no financial education when we're growing up and going to school. Now, this one is particularly close to my heart because I always wanted to be successful. My parents are immigrants that came to this country with not that much, and I always saw how hard my parents worked. So growing up, I wanted to become successful so I can give back to my parents and give them things that they never had. So I assumed that the way that you become successful is by studying hard in school, by getting good grades, that we can get a good job. In my house, that meant that I needed to go out and become a doctor. You know, your typical Indian stereotype. Along the way, I realized that I didn't want to be a doctor. I wanted to be an entrepreneur and I wanted to be an investor, but my parents didn't really like that, so they compromised. They said if you're not going to be a doctor, you have to at least be an attorney. So I went through college, I went through law school, and I went through all the schooling to learn how to become successful, but never once did I learn about money. I never learned about how to manage my money, I never learned about how to invest my money, and I never learned how to build wealth in the economic system that we have right now. The first bit of financial education that every single person needs to understand, especially if you live in America, is that there are 2 different ways that you can make money. You can make money from your labor, and then you can make money from your capital. You have to understand this if you want to be able to build wealth, because our education system and our schooling teach us how to maximize the income that we make here from our labor. You go to school to get good grades, to get a good degree, that way you can get a good job. This is the money you make from your labor. You go to work to get paid. Now, the idea of you going to school is so you can get a high-paying job. You go and you become a doctor, you become an attorney, you become an accountant, you become an engineer. You're a high-paid worker, you're a high-paid employee. But in the economic system that we have right now, the highest paid people and the most financially successful people in the country are not high-paid workers. It's people that know how to deploy their capital. Let me show you what I mean. So this is what school teaches us how to maximize. This is our corporate ladder. You go from analyst to associate to VP to director to the CEO. You go to the C levels. So school wants us to climb the corporate ladder. But what people who understand the economic system understand is they don't want to just climb the corporate ladder. They want to own the corporate ladder. Remember, we live in a capitalist society. This says it in the name. Now, you can hate it or love it. The reality is we live in a capitalist society. In the name, it tells you that if you want to become successful, you have to deploy your capital. It's in the name. So the people who become insanely successful understand this, and they're working to grow this. They want to invest their capital because now it's your money working to increase value instead of just your labor. There's a limit to how much you can work. There's a limit to how much value you can provide directly from your labor alone, but there's no limit to what you can do with your capital. This is where a lot of people get upset because they say, I'm disadvantaged. I don't have rich parents. I wasn't born into a lot of money, so how am I supposed to take advantage of the system? But what you need to understand is you need to use your labor to generate capital. That way you can use and deploy this capital. That way you can become wealthy in this economic system. Most people, the majority of people, are working for a bigger salary. That's what they assume is going to make them wealthy. But that's a lie. Our economic system has it in its name, capitalist. The way you become wealthy is by using your capital. That way you can earn a piece of profits. See, let me explain this because it took me a long time to understand how this truly worked. I had to read a lot of books, I had to talk to a lot of people, and I had to experience it myself because this is something I never grew up learning. When you work a job, you're getting paid for the labor that you put in. Now, you could be a high-paid person, you could be a low-paid person, it doesn't matter. At the end of the day, it's the same thing. You're working for the owner of the company. You can get paid a lot of money as an employee. Doctors make a lot of money, you have executives that make a lot of money, but at the end of the day, you're still working for the owner of the company. Now, there's a difference between the salary, the income you make, and the profit that a company generates. The profit is separate from your income. Now, what these people here, the investors, the people who deploy the capital are working for is not an income, it's not a salary, it's profit. They're working for a piece of the profit. So I'll give you an example. Let's assume that I go out and I start a company, and my company makes $1 million in revenue. So I sell, for some fun, I sell avocados. I sell guacamole, okay? I make $1 million in revenue from my guacamole company, but I don't get to keep all the money in profit. I have expenses to pay. Maybe I have $100,000 in avocado costs. I have $200,000 in employee costs, and then I have another, say, $200,000 in other expenses. So I have to pay my CEO, I have to pay the people that mash the avocados, I have to pay for the salt, the pepper, and everything else. This all adds up to $500,000 in expenses. Now, I have to pay the team in order to run the company. Right? I gotta pay my CEO, I gotta pay the people that work in the actual avocado to guacamole making business. That's my cost. You're getting paid for your labor. And if you're really good at making avocados into guacamole, you're gonna get paid more money. But once all the expenses are paid, there's another $500,000 in the bank account. The person who gets this is the owner of the company because now you own the equity. Now, you do have more and more companies nowadays that are distributing some of this ownership, the profit, to the employees, like here at my minority mindset companies, like at Market Briefs. We do a revenue share system where the employees get to share in the profits. But if you don't have that, what you need to understand is this is what wealthy people are working for. They're not working just to grow this by 5% or 6%. They want to see how can we drive more sales, that way we can get a bigger piece of ownership. And the way that you can do that is by working for this. This might mean investing in companies. It might mean investing in your own company if you have that sort of equity structure. It might mean investing in real estate or investing in startups. You want to use your money to buy assets, investments. That way you can build equity either in companies or real estate or some other sort of asset. That way now you can be the equity owner and get a share of this. Because now when you're working for profits, now you have the team of people working to help grow the value in the company. Now, there's another debate that a lot of people talk about. This, how much money should an employee be earning? You have all the time people talking about minimum wage, how much money people should be earning more money. And that's fine, but what you need to understand now as a financially educated person is a concept called fiduciary duty. I learned this in law school, and it was a new concept that I didn't understand. Fiduciary duty is who you owe your alliance to, who you need to take care of first. An easy way to understand fiduciary duty is think of it like this. You have a date scheduled with your wife tonight, and then one of your friends calls you and asks if you can play video games with them tonight. You can't cancel on your wife to play video games with your friend because your fiduciary duty is to your wife first. Well, in this case, in this corporate ladder, the executive's corporate duty, the people who run the company, the executive's corporate duty is not to the employees, it's to the shareholders. It's to these people. So the number one goal of the people that's running the company is to drive this, the profit higher. It's not to pay the employees the maximum amount possible, it's to drive up the profit. Now, you have to understand, there's a moral aspect to this, there's a legal aspect to this, there's a financial aspect to this. You want to make sure that your employees are happy. You want to make sure your employees are well taken care of. That way they want to come to work every single day. That way they want to produce a good product. But if you are just working here, you're going to be constantly asking and wondering why you're not getting paid more money. But what you have to understand is the way the system works is designed to benefit this person. It's designed to benefit the person who's working for this, not just the person that's working for this. So you can do two things. Either you can go and work for a company that's going to treat you better, or you can work for earning more of this. That way you can deploy your capital. That way you can own equity in companies and real estate. That way you can build your wealth by understanding how the system works. This is why financial education is so important. And this is one thing that I wish schools would have taught me, and I wish schools would be teaching this to people nowadays so we can understand how to win in this system, because rich people and wealthy people understand this, but most of us are never taught this. The second thing that's keeping so many people poor is this overconsumption. That way we can look rich so people think that we're successful. Growing up, my parents worked their butt off. They were working around the clock, 7 days a week. And I remember when we used to go to family get-togethers, my parents would always tell me and my little brother that we need to wear a polo shirt. We had a few shirts that were nicer from the polo company that had that little horse on it. And they would always say, make sure that you can see the horse. Get a shirt that has the horse on it. That way people think that you're successful, and they know that you're successful because you have a polo shirt on. Now, I didn't really understand much about what was going on at the time, but I listened to what my mom said and I wore these polo shirts. Now, we were not broke by any means. Like, I never worried about where my next meal was going to come from. I was never worried about how we were going to pay for the bills, but my parents were still working their butt off. Like, they were working around the clock. My dad would barely even get holidays off, but the whole idea was at least you look like you're successful. Now, fast forward to today, I've achieved a much different level of success, and I don't remember the last time I bought something with that horse on it, the polo. I mean, I like some polo clothes. If I like something, I'll buy it, but I have no need or urgency to go out and buy this or to show it off. And I talked to my dad about this, and he does most of his shopping at Costco now, and he laughs about it because there's this whole idea of trying to look more successful than you actually are. And the number one reason why so many people are broke today is because they're spending all of their money trying to look rich. The first time I had more than $1,000 in my bank account, I was in high school from all these side gigs that I was running. And as soon as I had $1,000 in my bank account, I immediately went out and I bought the shiniest, most sparkliest watch that I could find. It was a $1,000 watch. I took all the money that I had and I went out and I bought this watch. It was covered in crystals. I still have that watch. I really need to bring it onto YouTube so you can see it. But I bought this stupid watch that way I would look rich, but in actuality, that watch was keeping me broke. This single mindset of trying to look rich before you're actually rich is what keeps so many people broke, because what happens is you make money and then you have to make sure that everybody else around you is rich before you are rich yourself. So as soon as you get paid, you make sure that Apple gets paid, you make sure that Lululemon gets paid, you make sure that Gucci gets paid, you make sure that Amazon gets paid, you make sure that everybody else gets paid, and then you're left with the scraps. Once you break out of that mindset, then it almost becomes a game of trying to figure out how you can stop spending so much money on things that you don't need. Third is a concept of overfinancing. So something that I like to say is that traditionally, Indian people make $1 to spend 20 cents, while American people make $1 to spend $2 thanks to the help of credit cards and lines of credit. Now, neither of these things are right or the best thing that you can do with your money, but what you need to understand is we live in a spending culture. Our culture is designed to make you spend money, which is why you need to have this financial education and understand how this works. That way you don't go into debt to buy a whole bunch of things that you don't need, because now you are a slave to your banks. You owe your banks money, and anytime you get paid, the first thing you do is you buy all the stuff that you don't need, and then you pay off your banks, and then whatever's left is what you use to build your wealth. And at that rate, you will never become wealthy, because all of your money is going out to make your banker rich, and it's going out to make Amazon, Lululemon, and Gucci rich. The simplest way for me to explain this is if it does not put any money in your pocket, you should not be financing it, period. If you don't have the money to buy it in full, in cash, you can't afford it yet. This includes doing 0% APR on your phone and financing your car. If you don't have the money to buy these things outright, you should not be going into debt to buy them, because these things are not going to make you any more money. Now, I understand you can use your phone in your business. I understand you can use your car to get to and from work. But if you don't have the money to afford it, don't go into debt to buy it. I get it. You need a phone for your business. Maybe go back a couple generations of iPhones. That way you can buy it for a few $100s instead of paying $1,000 that you finance over time. And even though it's 0% APR, there's a reason why 0% APR is so profitable for banks and companies. When you go out and you buy a bunch of things with 0% APR, you don't feel that pain of spending money, because $1,000 isn't leaving your account today. You're just putting it on a payment plan for the next 12 months, and then you can go out and buy even more things with the help of 0% APR. So now you're going out and buying a whole bunch of things that you wouldn't have otherwise, and now you're putting all these things on 0% APR, and then what happens for so many people is you don't pay off your items, you don't pay off your cell phone and everything else in time, so now you get slapped with an 18 to 25% APR interest rate. And now you're stuck back in the payments game, trying to pay off your banker, trying to pay off these companies. That way you can finally have some freedom back. Now, you can use debt to make you wealthier, but wealthy people are not going into debt to buy their cell phone. Wealthy people are not going into debt to buy a car that they can't actually afford. Wealthy people are using debt to make themselves wealthier by using this money to finance assets, which are making them money, instead of financing liabilities, which are losing them money. And this brings me to number 4. You're confusing assets for liabilities. And let me diagram this out for you. That way it's very easy to understand. An asset is something that puts money in your pocket. A liability, I'm just going to shorten that, is something that takes money out of your pocket. This part is pretty simple to understand, but what happens is many of us are confusing liabilities for assets. Let me give you an example of this. Your home is what everybody calls your biggest asset. That is where you will be able to build generational wealth. This is why we want to push home ownership for all Americans. Now listen, I'm a real estate investor. I have a real estate salesperson's license. I used to help people buy and sell homes, and I'm an attorney. I've seen this from a lot of different angles. And when I was getting my real estate license back when I was 20 years old, one of the first things they teach you when it comes time to selling real estate is how you are going to help so many people buy the biggest investment of their life, their home. We are bred to think that your home is an asset. We are bred to think that our home is an investment. But wealthy people don't look at the home that they live in as an asset. Wealthy people look at the home that they live in as a liability, because it's not putting any money in your pocket every single month. Your home is a money pit. Now sure, maybe when you go and sell your home, you'll be able to sell it for a profit, but it's not guaranteed. We don't know when you're going to sell your home, and you only get that money when it comes time for you to sell your home. Up until then, your home is a money pit. Every single year, you got to pay your property taxes. Every single year, you got to pay for your maintenance. Every time you want to upgrade the kitchen or the bathroom or your kid's room, it's going to cost you money. You have to pay to fix the roof when the wind damages it, and you have to pay to fix that window when somebody throws a ball through it. But if I can sell you on this idea that your home is a big asset and it's going to be the biggest investment that you ever purchase, now what are you going to do? You're going to stretch yourself a little bit thinner, that way you can go out and buy a bigger home. Because now it's an asset. You're going to be able to give your kids this home one day. So now you go out and buy something a little bit bigger. Your debt payments are a little bit bigger, which means you have less money every single month to invest into assets. But at least you have a home. And now every single month, you're working to build equity in your home. You're working to pay off your property taxes. You're working to pay off your utilities. You're working to pay off the insurance. And then when it comes time for you to sell your home, hopefully you will have some equity in the deal. If it all works out, you will be able to sell your home for a profit and now you'll be able to put some money in your pocket, but you're still going to need another place to live. But what you have to understand is, why did you buy that home in the first place? Did you buy that home to make money, or did you buy it to make memories? If you're buying a home to live in, you're buying it to make memories. You're not buying it to make money on. While wealthy people understand that the home that you live in is a place where you make memories. Sure, if you make some money on it, great. But that's not the reason why they're buying the home. They're buying the home to make memories. If I want to make money in real estate, I'm not going to go out and buy a big home to live in. I'm going to go out and buy a rental property, because my rental property I'm buying for the sole purpose of making money. If you really want to make money from a home, buy a home that you're going to rent out for somebody else instead of buying a big home for you to live in yourself. So what you have to understand is, your home is a liability more than it is an asset. It is a liability until you sell it, and if you sell it, hopefully you'll be able to sell it for a profit. But what happens to so many people is, we fall in love with the idea of owning a home, and then we want a really nice home, we want a bigger home, so now we stretch ourselves thinner and thinner and thinner, and now we're living paycheck to paycheck. That way we can just own a home, but hey, at least you're building some equity in your home, right? Well, if you weren't doing that, you lived smaller and you didn't think of your home as an asset, you didn't think of your home as the biggest investment that you'd ever make, well, now you'd have more money every single month to invest your money into assets, to invest your money to actually build equity into real estate investment properties, to build equity into companies, that way now you can build real wealth instead of just working your butt off to buy a big home, which is only really making your real estate broker, your mortgage broker, and your banker richer, while it's keeping you broke, because now you're having to work overtime just to make the mortgage payments. Remember, assets are things that you buy to make you money. Liabilities are things that take money away from you. Wealthy people put their emphasis here to own more assets and put less emphasis here. In fact, what wealthy people actually do is they put their emphasis here, that where their assets buy them their liabilities. They use their investments to pay for their expenses. And last but definitely not least is understanding this idea of our money. What are you working for? Most of the time we assume that our paper dollars is money, but the reality is our paper dollars don't store value very well. Think of it this way: you work hard at your job all year and you make $50,000. Now let's assume that you take this $50,000 that you earn and you print it in cash. Now you have this $50,000 in cash, and let's assume you could put it in a duffel bag, and now you have a time machine. So you go in this time machine, you take this $50,000 worth of cash, and now we go forward 30 years. What do you think is going to happen if we go forward 30 years with this $50,000? Do you think that $50,000 will be able to buy you the same things that you can today? No, probably not. Chances are in 30 years that $50,000 that you earn today is going to be able to buy you way less in the future than it can today, because of something called inflation. That's why the value of our dollars keep dropping and the prices of everything keep going up. But let's go backwards now. Let's assume that you have this $50,000 in cash, and we can go backwards in time. We'll go back 30 years. Now, do you think this $50,000 is going to be able to buy you the same things that it can today? No. If we go back 30 years, you're going to be able to buy way more stuff with that $50,000 than you can today, because $50,000 30 years ago had way more buying power than $50,000 does today. So now, if you're working for this money, this paper dollars, and you just keep stacking and saving this money, because that's what we're told to do, at least that's what I was told, was I was supposed to work hard and then save as much money as possible. Well, this money that you're saving isn't growing because your bank isn't paying you any interest. It's actually losing value every single day. Your savings are losing value, effectively making you poorer each and every day just by saving your money, because inflation is way higher than what interest your bank is paying you. Money, at its core definition, is supposed to be some sort of store of value. So you earn $50,000 because of this labor that you put in, and the money that you have is supposed to store this $50,000. But our paper dollars don't do that. Our paper dollars are really just a means of exchange. It's a type of currency. It's a way for us to exchange our money. It's a way for us to buy things and do transaction with, but it's not a good way for you to store your money. That's why I call it fake money. What real money is a way for you to store the value of the earnings that you got. Traditionally, this would be something like physical gold, because gold is a store of value. It takes time, effort, and labor to mine an ounce of gold, and if you own some physical gold, you own a real representation or a real store of value. That's what gold is. We used to be on the gold standard here in the United States, meaning every dollar used to be a gold certificate. But we're no longer on the gold standard. In 1971, President Richard Nixon severed the dollar and the gold standard, which means you could no longer exchange $1 bill for a specific ounce of gold. Now, the dollar is separate from gold, which means that the government can print as much money as they want. The government can print as many dollars as they want, which effectively dilutes the value of each dollar, which makes the value of your money, your paper dollars that you're working so hard to earn, that you're working so hard to save, diluted each and every day. We just talked about the difference between a liability and an asset, but this is one of the reasons why it's so important for you to convert your dollars into assets, not just so you can become wealthy, not just so you can create cash flow, not just so you can take advantage of the system that we're in, but so you can actually preserve the value of your money. Because if you don't, your money is going to lose value each and every day in the bank, and this is what's happening to so many people. Inflation is known as a hidden tax. It's a tax on people that don't understand what inflation is. It's a tax on the financially uneducated, because as inflation continues to be very high, the value of your savings will continue to lose value each and every day, effectively making you poorer. So the people who pay this tax are the people that don't understand what inflation is. That's why it's a hidden tax. It's a silent tax. It's a tax on people who are financially uneducated. So if I haven't convinced you about the importance of investing your money because of the capitalist system that we're in, or if I haven't convinced you to invest your money that way you can own assets instead of liabilities, or if I haven't convinced you to invest your money that way you don't keep making every other company around you rich, hopefully this will be the reason why. Because if you don't invest that money, if you just own liabilities, if you just stack cash, well, that cash is gonna make you poorer each and every day, because the value of your dollars are dropping while the price of everything around you keeps getting more expensive, which is why if you want to at least preserve the value of your money, or if you want to grow the money you have, you need to own assets. That means owning shares of companies, stocks, or owning some physical real estate, actual assets, which will help to preserve, if not grow, the value of your wealth. Now, does this mean that every investment that you make is going to make you money? No, of course not. Investing has risks, but not investing has risks as well. Because if you don't invest your money, well, then your savings are going to continue to lose value to inflation each and every day. Everybody says that your income will determine how wealthy you will become, but that's not true. You can be wealthier with $50,000 a year than somebody making 6 figures a year, and I'll show you why in this video. There are 3 factors that will determine how wealthy you will become. Time, meaning how long you'll be investing your money for. Return, meaning what interest rate return do you get on your money, and money, meaning how much money do you invest. Most people think that if you make more money, you will be able to become wealthier because hopefully you'll be able to invest more money, assuming that you have the financial education to invest. But somebody earning $50,000 a year can outperform somebody earning 6 figures a year, even assuming they're investing the same percentage of their income, if the person making $50,000 a year can optimize these 2 things. If you make $100,000 a year and you invest 15% of your income, which is $15,000 a year, and you can get a 10% annual return on your money, and you start when you're 30 years old, well, by the time you retire, you will have about $4.9 million. And this is assuming that as you earn more money later on in your career, that you don't invest more aggressively. But let's assume now that you don't make as much money. You make only $50,000 a year, so you can only invest $7,500 a year, and you continue to do this even if you get pay raises. You only invest $7,500 a year, which is also 15% of your income. You also get a 10% return, but the difference here is you don't start when you're 30, you start when you're 21 years old. Now, you're not going to retire with $4.9 million. You are going to retire with $5.9 million. You will have an additional $1 million in your investment account. You are $1 million richer than the person making twice as much money than you, even though they're investing twice as much money as you, just because you started a little bit earlier. That's why the 3 factors that will determine how wealthy you'll become are time, return, and the amount of money that you invest. Most people assume that it's only going to be how much money you invest because of how much money you're earning, but real wealth looks beyond that. Now, if we dive a little bit deeper into the 3 different factors that will determine how wealthy you'll become, time, the return that you get, and the amount of money that you invest. Time is the only factor that we cannot change because we can't go back in time and start investing 5 years ago. So I'm going to go over time the quickest. The more time your money has to grow, the wealthier you will become. If you invest $625 a month, which is $7,500 a year, you get that 10% annual return and you start when you're 21, you will retire with $5.9 million. But now if, for fun, you started when you're 25 years old instead, now instead of $5.9 million, you would have $4 million. If you started when you were 30 years old, now you're not going to have $4 million, you're going to have $2.5 million. And if you started investing the same amount of money with the same rate of return at 40 years old, well, now you are going to retire not with $2 million, not with $1 million, but with $900,000. This is why it's better to start sooner rather than later, because the more time your money has to grow, the wealthier you will become. Also, I forgot to put the K here, 900,000. The next thing that will determine how wealthy you become is the return you can get on your money, meaning how fast you can grow your money. And there's two aspects I want you to understand here. One is how you can get a better return on your money, meaning how do you invest your money and where do you invest it to get a better return? And second, how do you prioritize and manage your fees? Because if you're investing your money in funds, whether it's an index fund, a mutual fund, an ETF, or you're putting your money into a 401k or IRA where your money is then invested into funds, well, you're going to be paying fees, and these fees can eat up the returns that you're getting, which will influence how wealthy you will become. Every single fund that you invest in, whether you're investing in your 401k or your IRA, or you're actively going out and investing in ETFs, mutual funds, and index funds, is going to cost you a fee. And you want to know what this fee is. This fee is typically called an expense ratio. And the reason why this is so important is because, well, if you don't know what the fee is, then your money manager could be charging you a lot more than you're wanting to pay. Because a 1% fee is going to cost you, well, more than just 1% of your wealth. Because a 1% fee, if in the same situation you had to pay a 1% fee on your investments, it's not a 1% fee on your $5.9 million. It's a 1% fee on every dollar that you invest, for every year that your money is invested for, and every dollar of profit that you get. So you're not just compounding your money, you're compounding your fees. And now in this situation, if you had to pay a 1% fee, you wouldn't end up with $5.9 million. You wouldn't even end up with $5.5 million. You wouldn't even end up with $5 million. You wouldn't even end up with $4.5 million. You would end up with $4.3 million. And that difference, that $1.6 million difference, is going into your money manager's pocket. This is why you want to know where these fees are and if these fees are worth it. Sometimes the fee will be justified if you can calculate how much this fee will cost you and you're going to get enough returns to justify the fees. Other times, well, most of the time, the fees are not worth it, which is why you want to be looking for lower cost funds. But besides just keeping an eye on your fees, you want to know how you can get the best return on your money. Because if you don't get a 10% return on your money, and instead you got a 7% return on your money, assuming all things are equal, well, now you're not going to have $5 million or $4 million. Now in this instance, you are going to retire with $2.2 million. This is why the financial education is so important. That way you can get the best return on your money and get your money to grow as fast as possible. The return that you get is generally correlated, not always, but generally correlated with the amount of risk that you take on. The general rule of thumb is higher risk, higher potential return. Like here, I have this risk reward ladder, and on the top we have savings, keeping your money in your savings account in the bank. This is generally considered the least risky option because when you put $100 in the bank, you know that you can go there tomorrow and get the $100. The problem is you're not going to get that much return on your money. Like if you put your money into a traditional savings account, you might get a 0.2, 0.3, maybe a 0.5% return on your money. If you put your money into a high interest savings account, maybe you'll get a little bit more. But still, it's a very little return on your money. It's going to be difficult for you to build serious amounts of wealth by just saving your money in the bank because you're not getting any returns. Then if you want to take on a little bit more risk, you can put your money into a CD, a certificate of deposit at the bank. Still though, that's not going to give you that high of returns because, while it's a little bit riskier than your savings account, because when you put your money into a CD, your money is tied up for a year or 5 years or 10 years, you're still not getting any returns, which is why I don't really like talking about investing your money in CDs because the returns are horrible. Then you have what I like to call passive investments. And this is just kind of like a catch-all term for your general investing where you're not actually managing and operating the investment yourself. So this could be investing your money in stocks, investing your money in real estate, investing your money into these types of assets. And yes, I know you still have to manage your investments when you invest your money into stocks or real estate, but you're not actively operating the investments like you are a business if you're starting a company. So when I talk about these types of passive investments, these are more of your general investments when most people think about investing their money into another asset. Now, the types of returns you get here are going to vary. Like the average stock market and real estate return over the last century has been somewhere between 7 to 10% return a year, year over year. Now, does that mean you're going to always see that return on your money? No. You're going to go through down periods, you're going to go through up periods. But over the long term, we have seen the markets grow by 7 to 10% a year. Now, how do you influence the returns here? Well, this is going to go down to your financial education and how involved you want to be with your investments. You might have heard me talk about passive investing versus active investing. Passive investing is where you're just passively putting your money into the markets and you don't really manage your investments. You're not really keeping up with companies. You're just putting your money into funds and you're letting the funds do their thing. This is going to give you slightly lower returns because you have lower risk. On the flip side, you can be an active investor where you're going to be a little bit more involved. You're going to be researching more companies. You're going to be putting more time and effort involved to find the best companies, to find the best investments, to find the best real estate deals. And then you're going to go and invest your money into these individual investments when you find a good deal. You can get better returns, but you also take on more risk, meaning you can lose more money. So again, higher risk, higher reward. If you are a passive investor, if you don't know what passive investing means, I'll link another video on my channel where I talk about this down in the description. But if you are a passive investor, passive investing is going to give you lower returns, lower risk. If you are an active investor, that's going to give you higher potential returns, again, potential returns, but also higher risk. Then, if you want even higher returns, you can look into more of active investments. And I'm not talking about the active passive investments, meaning actively investing your money into stocks and real estate. I mean active investments like starting your own business or by buying a business and operating it. These can give you the highest returns because you can start $1 million business with less than $1,000. But again, higher risk because most businesses will fail. In this instance, you're investing your time and your money, and you're working to grow your money by putting your time into the investment as well. Starting a business can give you the best returns, but it has the most time and the most risk. If you put your money into these passive investments, things like stocks and real estate, you can get still good returns, but the returns are going to depend on now, are you more of a passive investor or more of an active investor? And then you have more of the non-investments where you're just trying to keep your cash safe, something like a savings account and a CD account where you have much less risk and very little returns. This brings us to the third factor which will influence how wealthy you become, which is how much money you invest. And yes, this is another factor that you can control. We've talked about what happens if you adjust this and if you adjust this, but what happens now if you adjust this? Let's assume now that instead of investing $625 a month, which is $7,500 a year, you invest $100 a month, which is $1,200 a year. What then? Well, now if you can get the same 10% return, you start when you're 21 years old, well now you are going to retire with $1 million. This is where most people focus. Most people focus only on this. They say that if you make more money, you will be able to become wealthy. But most of the time when they say that, they're not thinking about their investments. They're thinking about, well, if you make $100,000 a year, you have more money to spend, meaning you can have a nicer car and you can buy a bigger home. They're not talking about their investments. But the real reason, the only real reason why making more money can make you wealthier is because you have more money to invest. But again, you need to look at the three factors. You have to look at the interest rate that you're getting. You have to look at how long you're investing your money for, and then how much money you're investing your money for. And just for fun, let's talk about what happens if you invest $1,000 a month, which is $12,000 a year. You get the same 10% return. You start when you're 21 years old. Well, now you are going to retire with $9 million. So how can you have more money to invest? Well, this really comes down to two factors. One is spending less money, so you have more money to invest. And the second is earning more money, so you have more money to invest. This is where what happens to a lot of people is you start getting into this investing game. You're making $50,000 a year. You're investing 15% of your income, which is $7,500 a year. And you see the potential returns. And now you say, okay, yeah, I like this whole investing stuff. I'm going to try to squeeze a little bit more money out of my pie. Instead of me investing $7,500 a year, I'm going to try to invest $8,000 a year or $8,500 a year. But what you're doing here is you're trying to squeeze more money out of this limited pie. There's always going to be a limit to how much money you can save. There's almost going to be a limit to how much money you can squeeze out of this limited pie. So if now you want to optimize this, how much money you invest, I also want you to remember that you can work to grow the pie. Take it from $50,000 a year to $500,000 a year, because now if you continue following the same system of investing 15% of what you earn, well, now in this case, you're not going to be investing $7,500 a year. You're going to be investing $75,000 a year. Now let me emphasize this one more time. This isn't the only factor that will determine how wealthy you will become. You also have to look at how long you invest your money for and the returns that you will get. There's a whole art in getting better returns on your money. That's the whole financial education space of how you invest your money to get the best returns. There's also an art of how you can earn more money. This is more on the entrepreneurial side of financial education. How can you increase your income? Because if you go to your boss and say, hey boss, can you 10x my income? They're probably going to say no. Actually, I can guarantee you they're going to say no. But this is where now the question is, how can you actually increase your income to something where you're going to have a lot more money to invest? Well, either you're going to have to get a complete career change, you might have to get some more certificates, you might have to work a second job, or you can work to create your own income. Because when you work to create your own income, there's no limit to how much money that you can earn. And it also doesn't matter how old you are when you start, but it's a whole different beast of entrepreneurship, learning how to sell something, learning how to create a product, learning how to find customers. It's its own animal, but it can allow you to earn more money. The key is when you earn more money, why are you working to earn more money? If you're working to earn more money just so you have nicer stuff, well, you're doing it the wrong way. If you're working to earn more money, that way you can invest more money, then you're doing it the right way. But even if you're not an entrepreneur person, what you can do now to invest more money without having to go out and create a new income or start your own business, what you can do now is next time you get a pay raise, next time you get a bonus, don't go out and inflate your lifestyle. That is the quickest key to becoming wealthier faster. When you get an increase in income, don't increase your lifestyle. Instead, what you could do is take a pay raise and invest all of that. Or if you really want to start living a little bit bigger and you don't want to invest all of it, then at least take a percentage of your new pay raise, of your new bonus, of your new promotion, and take this new income and use this money as an investment bonus. That way now you're also investing more money. Because now if you're investing more money, you're also going to see more money grow and compound to make you more wealthy. That's why if you want to become wealthy, you have to look at it as a holistic picture and not just focus on this, but also focus on this and this. Because if you put in more money, but you're not getting a good return, or if you're not getting enough time on your money, well, it's going to be a lot harder for you to become wealthy. Now, of course, you can compensate this with this, and you can compensate this with this, but you have to understand these three work in harmony with one another, which is why you want to work on this by starting sooner. You want to work on your financial education so you can get better returns, and you want to work on growing your income so you have more money to invest. Debt is a tool. It can make you very wealthy, or it can keep you poor depending on how you use the debt. If you're using debt to buy cars and clothes and shoes and purses, well, now this debt that you're using is keeping you poor, but it's making your banker rich. But if you're using debt to buy rental properties, hard assets that pay you with cash flow, now this debt can make you rich. The number one reason why the majority of people will never have a chance to ever become wealthy is because they're using all of their money to go out and buy things, liabilities, which keep them poor. And then when they want more liabilities, they're going out and they're financing these liabilities through the help of debt. So now you're going to the bank to help them pay for your car. You're going to the bank with your credit card to help them pay for your wardrobe. You're going to the bank to help them buy you some new name brand clothes. See, when you use debt, you're using tomorrow's income to pay for today's expenses. Because when you go out and you borrow $1,000 from the bank, whether it's from a loan or a credit card or a home equity line of credit, you're borrowing $1,000 and you're using this money today. Then you're going to have to pay this $1,000 back from tomorrow's income plus interest. Now, if you borrowed this $1,000 from the bank and this $1,000 that you borrowed can make you $2,000, then it's no big deal, because now you can take this $2,000, pay back the bank, pay them the interest, and put some money in your pocket. So this debt doesn't bother you. But if you take this $1,000 from the bank and now you go out and buy liabilities which are losing you money, well, now this is how you become poorer each and every day, because now you have to go to work tomorrow to pay off yesterday's expenses, and then you got to go to work the day after that to pay off yesterday's interest. Now, while this type of consumer debt can destroy so many people's finances and it can destroy so many people's opportunity to ever become wealthy, there is a way out if you have the right financial education and if you know how to get rid of this consumer debt the right way. That way now you can use your money the right way to make yourself wealthy instead of just making the bank rich. And doesn't matter what kind of debt you have. Student loans, credit cards, mortgages, car loans, the things that I'm going to go over apply to all kinds of debt, and these are things that you can start doing today. That way you can start paying off this debt a lot faster than you would otherwise. The first thing you got to do before you do anything else is you have to organize your debt. You got to know how much debt you have, you got to know the different types of debt that you have, and you need to know how much interest these debts are costing you. If you do not know this, you will not be able to come up with the proper strategy to pay off your debt quickly. This part can be a little bit painful depending on how much debt you have, because you're going to have to look at exactly how much debt you have, and you're going to see how much this is costing you every single day. But you have to do this in order to get started. You need to list out every different type of debt that you have, how much this debt is costing you, meaning what's the interest rate, and how much of this debt that you actually carry. Once you do that, I need you to be honest with yourself, and I need you to ask yourself, how disciplined are you financially? Are you still that person that got you into this debt in the first place, or have you changed? Maybe you got into this debt 5 years ago and you turned your finances around and you no longer spend the way that you did. Are you disciplined now? Yes or no? Once you answer that question for yourself, then you can pick a strategy, the debt snowball strategy or the debt avalanche strategy. The debt snowball strategy is the strategy that Dave Ramsey talks about all the time. What this says is you are going to list your debts not by the interest rate that you're paying, but by the size of the debt. And what you're going to do here is you're going to pay off the smallest debt first, and then go to the next smallest, and then the next smallest. The whole idea behind this is you're going to ignore the interest rates, and you're going to pay off debts in a way where you can pay off the smallest balance first. That way we can get the small wins. That way we can get the psychological reassurance that you're doing something right and that you're winning. Here, with the debt avalanche model, what you're going to do, this is assuming that you're more disciplined, that you have the ability to control your spending, and you have the ability to stick to a financial plan. Here, you're going to organize your debts based off of the interest rates. And then you're going to pay off the highest interest rate debt first, because that's the debt that's costing you the most money. Because if one debt is costing you 20% a year and another debt is costing you 7% a year, you're paying way more in interest on the 20% debt. So you want to pay that one off first. This debt avalanche model goes with that method. The reason why this is for people who are more financially disciplined is because you're not going to get those same psychological wins as fast as here, because here you're paying off the smallest balance first. So you'll pay off one debt faster here than here. But in this model, you'll be able to keep more money in your pocket because now you're attacking the debts that are costing you the most money. The reason I need you to be financially disciplined if you do this one, even though it's going to save you more money, is because if you don't have that financial discipline and now you're trying to pay off your first debt balance, which is a big debt balance, which has a high interest rate, and you keep paying it off, but you're not seeing that big difference, that big kind of win where the debt goes away yet, well then you might get demotivated. And if you do that and now you stop paying off your debt, now you're in a worse position than if you would have just stuck to this model. So this is where you got to be honest with yourself. If you're financially disciplined, if you can stick to a financial system, then go with this. It'll keep more money in your pocket. If you are not, then stick with this, because this will help you pay off your debt. So this is what the process would look like, assuming that you only have 3 debts. You have student loans, you have credit card debt, and then you have your mortgage. Let's assume that your student loans are costing you 6% a year, your credit cards are costing you 16% a year, and your mortgage is costing you 4.5% a year, and you have $15,000 in student loans, $22,000 in credit card debt, and $300,000 on your mortgage. Now, if you're following the snowball method, now what you want to do, again, is go by the smallest balance first. In this case, you're going to go with student loans, then the credit card, and then the housing debt. Now remember, your credit card debt is costing you way more, 16% a year. But with this debt snowball method, you're trying to go for the big wins first. You want to attack the smallest balance first, which is why you're going to go after the student loans, because you'll be able to pay this off quicker than the larger balance. So that way you get those psychological wins and you can get rid of some of the debts. If you have that financial discipline and you can stick to that financial system, then what you're going to do is you're going to pay off the most expensive debt first, the credit card debt. It'll take you a little bit longer here because you have more debt, but now you're getting rid of the highest interest rate first. That way now you can stop bleeding cash, and then you can go to the next one that's costing you the most money. Here, the student loans, and then you need to attack the housing payment. So here, you're gonna go by the interest rates. Here, you're gonna go by the balance. I don't care which one you do, as long as you stick with the strategy, and I just need you to be honest with yourself. Because the worst thing that you can do is say, oh yeah, I like the idea of trying to save some money here and paying off the higher interest rates first, but then you can't stick with it because then you get demoralized or you get demotivated. If that's you, be honest and just stay here. It's okay as long as you just stick with the strategy. The second thing that I want you to do is I want you to stop sending in monthly debt payments. I'll show you why. So let's assume that you have $30,000 of credit card debt, and this is costing you, let's say, 15% annually. And so right now, your monthly payments for the purposes of this video are $500 a month. So what most people do when they have this type of situation is they're gonna send in a check for $500 a month, or it's gonna be a direct deposit, whatever it is, an automatic payment where you're paying $500 a month to your credit card company. I want you to stop doing that. If you follow that model, so let's say option 1, and in this model you're paying $500 a month, it's gonna take you 112 months to pay this off, and you're gonna end up paying this $30,000 plus $25,800 in interest. Instead, what I want you to do is option 2. In this case, instead of sending $500 a month, I want you to send in $250 every 2 weeks. So now you're gonna send in bi-weekly payments, and it's essentially gonna end up being the same. You're sending in $250 every 2 weeks, or $500 over the course of every 4 weeks. But now you're not gonna pay off your debt in 112 months. You're gonna pay off your debt in just 95 months. And now you're gonna pay the same $30,000 of your principal balance, which is what you owe. But in the interest side of things, instead of paying $25,800, you're only gonna pay $21,200. So you're gonna save over $4,500 in interest, and you're gonna save another year of paying off this credit card bill, just because now you're paying every 2 weeks instead of every month. This is one of the simplest hacks to pay off your debt quicker. And the reason why this works is because in this situation, option 1, you're gonna send in 12 months worth of this payment every single year, because you're sending in $500 a month, and you're gonna do that 12 times. In this situation, there are 52 weeks a year, which means you're gonna send in 26 payments of $250, which ends up being 13 payments of $500 a year, because in this situation, you're sending in $250 26 times, which is the same as sending in $500 13 times, but you don't even see it happen, because in this situation, you're doing it gradually over the course of a year. So you won't even notice the difference in your finances, in your bank account, but it's gonna really show up in your bank account when you see how much faster you can pay this down versus this down. Now you know in what order to pay off your debts, and now you know how to pay off your debts even quicker. The third thing you gotta do is you wanna attack your debts even harder. And the quickest and the simplest way to attack your debts even harder is to cut down some of your expenses so you have some extra cash. And now when you have this extra cash, throw it at your debt payments. That way now you have more money going directly to the principal value of your debt. Because when you pay this extra money to your debt payments, you don't gotta pay any interest on that. So anytime you send in an extra $100, the $100 is going directly to your principal balance, and you don't have to pay any interest on that. So this allows you to pay off your debt way faster, but you gotta learn how to find this cash. This is where right now you wanna cut back on some of your expenses. That way you have some extra cash in your pocket, because one of the easiest ways to keep more cash in your pocket is just by not spending it. So if you don't gotta go on vacation, or if you don't gotta go buy those brand name clothes, or if you don't gotta go out to eat, this is an easy way to put a little bit more cash in your pocket that you can throw directly towards your debt, because now you have some extra cash, and instead of just spending this money, you're gonna take this extra cash in your pocket and you're gonna use it to pay down your debt. That way now you don't have to worry about this debt anymore. This is something that takes a lot of sacrifice, and this is something you have to be able to do. That way you have the financial discipline to actually build wealth, because it's not just a matter of sacrificing some of the nice things that you want, it's knowing what's important to you and doing whatever it takes to make that happen. Plus, everybody has at least a few $1,000s worth of stuff in their home that they don't use. Old clothes, old furniture, old TVs, old phones, old computers, old electronics. Everybody has a bunch of stuff sitting around in their home that's just sitting there collecting dust. If you have the stuff that you don't need, sell it, and when you got that extra cash, use it to pay down this debt. This is an easy and simple way. That way now you have some more cash that we can throw just at your debt, but I don't want you to live broke for the rest of your life. The whole idea behind being financially educated and becoming wealthy is not so you can keep pinching pennies and keep couponing. It's so you can live the life you want, buy the things you want, enjoy the luxury you want without worrying about the price. But in order to get there, you have to know the financial discipline that it actually takes. And that's why now, once you know how to control your spending, now it's all about growing the pie and earning more money. Because the fastest way to pay down your debt is to first have a strategy. We talked about that. You pick the debt avalanche, you pick the debt snowball. Then you gotta know some of the basic hacks, like just by doing the bi-weekly payments instead of doing the monthly payments. Now it's all about finding some extra cash and throwing it at your debt, because like I said just a second ago, every extra dollar that you put towards your debt payments is going directly towards your principal balance, and you don't have to pay any interest on that. So the more extra cash you have, the more you'll be able to pay down your debt faster. So the fastest way to pay down your debt is not just by following some of these hacks, it's by getting more cash. And the simplest and quickest way to get some more cash is to cut back on some of your expenses. But at the end of the day, there's a limit to how much you could cut your expenses. There's a limit to how much you can squeeze pennies out of yourself, but there's no limit to how much money you can earn. So what I want you to do is first, you gotta have the financial discipline of knowing how to live below your means, because that's the discipline you need to understand how to manage your money. If you don't have that discipline, it doesn't matter if you're making $100,000 a year or $10 million a year. If you don't know how to manage the money you have, you will never be able to build wealth. But once you know how to do that, now I want you to think a little bit bigger. How can you expand the pie? How can you grow the amount of money that you're making? Because there's no limit to how much money that you can earn. And if you can earn more money, now what you want to do is you want to take this extra cash and throw it towards your debt. And the faster you can earn this extra cash, the faster you can pay down this debt. Some of the obvious ways to earn some more money are by putting a little bit more effort into your job. Maybe you're working overtime. Maybe you get a promotion. Maybe you get a raise. Maybe you get a bonus. Maybe you're gonna work a second side job. Or maybe you can try to get another job in sales where you have more upside potential, where now you're earning on commission. These are all ways that you can earn more money at your job, but I want you to also understand what the full range of possibilities are. We are living in the digital age, the internet age, and what I need you to do is I want you to spend some time learning how you can make money on the internet, because the way the internet works is people around the world are spending time on their phones and their computers, and more people around the world are doing this now than ever before, and this is a trend that is not slowing down, and it's not going to slow down anytime in the near future. So what I need you to do, instead of just working harder at your job, which is great, that's an accessible way for you to start earning some more money right now, but if you want to really be able to scale the amount of money that you're making, which you can use to now pay down your debt and you can use to help build your wealth by investing into assets, you need to know how to make money on the internet. The way it works is you have to understand how to create content, how to drive eyeballs to whatever it is you have, whatever brand you have. You need to create content, get eyeballs onto you, then you need to learn how to turn these eyeballs into dollars. Look, the easiest and fastest way to pay down your debt is to first have the strategy, you have the financial discipline, you have the financial education, and once you have those things, you have the system, you just need more money to throw into the system. That way now the system has cash to actually pay itself off. And so now if you want to do that faster, you need some more cash. Yes, you can work harder at your job, but if you really want to get there faster, you need to know how to create new streams of income, and the internet has made it more accessible than ever. That doesn't mean it's easy. It's actually very hard, because now everybody has access to the internet. But what I want you to do is understand how you can turn the internet into a machine that's printing you money. But you have to learn how to make money on the internet. How do you produce content that people want to see? Now, how do you turn this content into something that's going to produce you dollars? If you can figure that system out, you will have a new stream of income that you can use to pay down your debt and start buying you assets. Plus, once you start seeing more of the financial success and you have more of a financial breathing cushion, you're going to be more interested in learning more about how do you actually buy assets? How do you create passive income? How do you create new income streams from the money that you have? How do you invest your money to build wealth? This is what financial education is all about. First, creating the financial breathing room, and then it's all about buying assets. That way assets can pay you with more money, because at the end of the day, nobody can work 24 hours a day, 7 days a week, but your money can. This is why you need to have the financial breathing room, because if you're working all day and night just to pay off your debt, you will never have the opportunity to build wealth. The way you build wealth is by owning the assets. And the fifth and final step to really paying down this debt as fast as possible is to not make the same mistakes that got you into this financial mess in the first place. Because if you're spending all your time now working to come up with the right debt payment strategy, and now you're cutting your costs so you have some extra cash, you're working hard to earn some extra cash, that way now you're just throwing money at your debt, and then you go out and you see this brand new TV on sale, and you're like, ooh, this $2,000 TV would look really nice in my room, except I don't have $2,000. And then the salesperson tells you that this sale is gonna expire on Friday, and on Friday the price is gonna go up from $2,000 to $3,800, and then you don't want to have to pay $3,800, so what do? You pull out your credit card, you open a new line of credit to buy this new TV, and now you're starting right back where you were. This goes back to having the right financial discipline, because if you do not have the financial discipline to understand how to control your spending, you will never have the opportunity to build wealth. If you want to be able to pay down your debt and be able to build your wealth, you need to have the financial discipline of knowing what you can buy. And this is where you got to know what you can afford, because we live in a spending culture and a debt culture where when you want something, you got to have it now. And I want you to have the nice things. I want you to have the luxury things. I want you to have the exotic, expensive things. I just want you to be able to afford it first. That means no more financing something that does not put money in your pocket. If it's not paying you, you can't finance it. And second, if you want to be able to buy something, I want you to be able to afford it. And so when we're talking about being able to afford something, the easiest way to understand that is just to follow a rule of 5. If you can't buy 5 of them, you can't afford 1 of them. So when you see that $2,000 TV and you don't have $10,000 in the bank, well, you can't afford that $2,000 TV. Now you might be thinking, but Jaspreet, that's really hard. And you're right. Becoming wealthy is not easy. If it was, everybody would be wealthy. But this is where you got to decide. Are you willing to pay that price today? That way you can pay any price in the future. If so, you got to be willing to put in that work. That way you can have that extra cash. That way you can invest. That way you can build that wealth. Because once you have that wealth, hey, you can buy whatever you want, because now you're wealthy. The person that's paying for everybody else's credit card perks. You are the person that's paying for all the banker's bonuses. You are the person that's paying for those private jets. And the expense is you don't get to build your own wealth. You don't get to take care of your kids financially. You don't get to take care of your wife financially. You don't get to take care of your husband financially. And this is why right now,